All right, we're back for another episode of the YVR REMO show, and today this is an important one. It's been top of mind, been in the news frequently around renewals, upcoming renewals. We just spoke on this topic actually in April earlier in this year, and we want to continue on this topic because things are changing. Stats are coming out fast and furious, and one of the big pieces of data that really hit home for us is the fact that 19% of all renewals in the country are actually coming up for renewal in the next 12 months. And that's a massive number. And even more of a shocking stat is 69% of those folks that have those renewals coming up are in significant fear of payment shock. So we want to go through what that means today. There's a few numbers and stats that we're going to continue to touch on throughout this episode, and we want to go through just some of the critical differences that we're going to see over the next 12 months, some of the options that you have at your disposal as you kind of navigate through this time, and most importantly, all of this is going to be summarized in a very clear and concise guide. So for anyone that's listening to this episode or watching this on video, make sure to connect to the landing page that's in the notes. There's going to be a very detailed guide on all of these takeaways. So if you're somebody that likes to take notes, no need to take notes on this one. We have a lot of info, and we're really going to prepare you for the next steps here going forward. So I'll pass off to Tyler. I know you got some numbers there that can be helpful to just get started here.
Sure. Yeah. And just to reiterate, like part of the reason, or the main reason we're hitting this again, last time we talked about this was sort of the start of spring. And at that time, it really looked like inflation was rolling over, rates were coming down. So it was less of a story. But now, like, definitely the biggest story in the mortgage and perhaps real estate world moving forward over the next 12 months is your mortgage renewal. And yeah, that number, almost 70% of people are worried about their payment. Like, just to give you some idea, like an average 5-year fix taken this time 5 years ago, you're sitting just under 3%. You know, the example I'm going to use is around 2.79. When your mortgage is coming up for renewal, the new mortgage balance you'll be taking is going to be around $445,000 remaining. And I'm comparing a rate that you would probably take. I'm going to use a 3-year because that's just been, you talk to any mortgage professional, the most popular term taken in 2023 is without a doubt been a 3-year fixed. You're looking at a payment increase of around $1,300 a month, right? So, you know, that's a big number. It can, worry a lot of people. I mean, you would hope income over that time start to increase, but it's important to keep that in mind because that may mean for some people lifestyle change, right? That may mean, trying to add a second mortgage or restructure their loan. There'll be a lot of sticker shock, right? So that's why we're hitting on this topic again, is because we want to make sure people are doing everything they can, right? So, the biggest difference, it's not earth-shattering news. We're coming off of the cheapest rates we've had, in Canadian mortgage history to the most expensive ones we've had in over 15 years. So if you're not planning for it, that's going to be a pretty big sticker shock. And the whole purpose of this is to get this information out so people are going to take the time to put everything in place, run those numbers early, and really start assessing their options well in advance to hopefully kind of ease their concerns leading up to renewal season.
Yeah, really good points. And I mean, just to touch on a couple different types of mortgages and the people that are going to have the biggest payment shock. So like anyone that was in a fixed rate term for more than, 2 or 3 years, again, you're probably in a pretty low and cheap interest rate. You're going to be coming up for renewal in an interest rate that's probably double, if not a little bit more. So you're going to see a significant increase in payment in those situations. There's an adjustable rate variable mortgage. And as the Bank of Canada has raised rates, your payment is automatically increasing as well. Those people coming up for renewal aren't going to have as big of a shock because your payment has forced increase every time the Bank of Canada has risen. And then a true variable with a static payment essentially means that although the Bank of Canada has raised rates countless times, you might have not changed your payment at all, just meaning that you're probably not even covering the interest at this point, let alone any principal. And those are also mortgages that are probably going to have a pretty massive payment shock coming up for renewal. So, if you're in a fixed rate or if you're in a variable and you haven't changed your payments, you should definitely be getting ahead of this and start planning. I mean, people are talking about selling their homes because of the impact that this is going to have. And again, I think that there's a lot of different ways depending on your situation, the equity in the property, what you qualify to do. I think that there are definitely a lot of options to be able to retain your home and get through this tough period. Again, we're calling it a period of time because this very likely won't last forever. Rates will come down to a more reasonable level, and we'll talk about some of the options here, probably moving it over to Dean, but re-amortizing, pulling out some cash just to live off, right? If you literally can't make the new payment that's being offered to you, we've seen people that are just throwing an extra 40 grand in their bank account. They're pulling it out of their equity and they've got a slush fund of 40,000 to supplement their income for the next 2 years or whatever that number is.
Before we jump into some of these options, I think a big lingering concern for a lot of people is just requalification. What does it look like? Is it going to be even feasible to requalify to make changes? And I mean, those are certainly situations that are going to be concerning, and more reason to reach out and look at your options well in advance. So if your mortgage is coming up for 12 months, reach out 100% as soon as possible. If even 24 months, it's good to start planning. If there's something we can do to adjust an income structure, whether you're self-employed or commission based, and there's something we could look at as an option to help you and prepare for the upcoming renewal in 2 years or whatever the case may be, more time the better to start making changes if requalification is going to be a concern. So I think just to really hammer home, like, the timeline of when to look at your options is very, very important to get on that really early. We've seen renewal packages from really all major Canadian lending institutions with rates, significantly above market rates. And so what I mean by that is, if you have a mortgage coming up for renewal, typically the banks actually won't send you any form of communication until closer to maturity. So, these would be for folks that are probably within the 6-month window of their renewal date. They're going to be receiving letters and packages from their lenders with rates a lot higher than what is available today. And that's been going on for years and years and years. That's nothing new to this current timeline or this current period of time. That's just a common strategy, common sales strategy that the banks take, where they're really just sending you a letter and assuming that you just sign it, and that's the easy button. A lot of people will just take the automated renewal letter and just take that and move forward, because it's just that you just sign, you move forward, and it's done. But the things to keep in mind is that nothing changes on the terms of your mortgage from how much time you have left in your amortization, and you're quite regularly taking a higher rate than it's available in the market. So, when you look at options, which we're going to jump into, like re-amortizing the mortgage, which again, we'll get into more detail on what that looks like, adding more money, what Derek mentioned, to supplement extra cash to get you through these times. All of that would not be available in this type of scenario where the bank is just sending you a renewal letter. You're stuck in that case. So very important to not sign any letters of that nature until you talk to a mortgage professional or reach out to our company, because that is where we can intervene and really make a difference. So just really wanted to hammer home on that piece. Looking at the way these departments work. So staying on this topic of, you get this letter, get this package. Well, where does that come from? It comes from a renewal department. So, a lot of these lenders have renewal departments. They may call them retention teams. These are people that work in those departments and are really just, their goal is to just sell you on signing that document as soon as possible. They are not giving you any advice on what we just talked about or what we're going to get into from an option perspective. They're going to do everything they can to get you to sign that. And typically they're going to use, potentially you may take it as a threat from a perspective of, sign this now, you have 3 days to sign this, or the rates are going up even further. And, a lot of times that's just not true. It is a tactic to just get you to sign that document and move forward. So again, don't panic if you get these letters. Don't panic if you get these phone calls. Just reach out. We can calm the nerves. We can likely do a lot better and have a lot more time in our hands. So with that, let's dive into these, kind of what to do. So I kind of touched on it just right there. First piece being shop, reach out, look at your options. moving forward from there. Maybe Tyler, you can kind of jump into that next step.
I hear all that, and like, one thing I'll say about banks is like they've actually, I'm going to hammer them pretty closely here, but like on the other side, they've through all the variable rate increases that have happened, like they've been very forgiving and helpful, because like, the last thing they want is a foreclosure, right? At the same time, banks are going to bank. Like this is a business, right? They want to extract as much interest income out of the borrowers as they possibly can, and just to beat the chest of a good mortgage broker. This is part of the value add, right? Like banks are getting in touch with clients early on renewal when rates are going down. Now, why would they do that? Because they're trying to lock you into a high rate now, because they know rates are trending downwards to, again, extract more interest income out of you. Now, what we're seeing a lot of times too, because interest rates are continuing to going up, they're sitting back and they're waiting till like the last minute or the last month. They strategize this, right? You kind of have to think like this is a business for the bank. So why are they going to offer you a renewal when they see the trend for rates has been upwards, right? And Dean, you're right. Like the service provided about offering terms and options, it's not really there. I was talking to a client yesterday, and they got, and I'm not going to name the bank, but their renewal offer came through their mobile app. It was like a message on their app saying, "Here's your renewal offering. Click here." Like imagine that, you just click a button on your app and boom, you're locked into like a new like 3, 4, 5 year fixed rate term. So it's you just have to think about it, right? Like again, this is a business, this is what they're trying to do. They're trying to, again, extract as much interest income out of you as they possibly can. So yeah, I mean, the first thing you can definitely do is just shop. I mean, much like everything in life, when you're negotiating, the first offer, the first price probably isn't the best. So, don't be fooled by this. You have, 36, 48, 72 hours to make this decision. Make sure I guess to walk that further back, like if you've planned beforehand and you get that, you're a little bit more prepared for it, because, as I say, like the first offer is rarely the best offer. And certainly one trend we've noticed, if your bank is communicating with you, they seem to mostly be talking about 5-year terms, right? They're like, here's our 5-year fixed, here's our 5-year variable, call us, in 3 days and let us know what you want. Just so you're aware, there's other terms. You can take a 1 year, you can take a 2, 3, 4, 5-year fix. There's usually 2 sets of variable. There's a 3-year, there's a 5-year. You can take an open term. Like they should offer you their full suite of mortgage terms and rates available, not just the 5-year, which is just because it's the most common one taken. It's the one that's going to earn the bank the most, and it's actually probably the one that's going to pay the renewal specialist the most, right? So just make sure you're aware that when the renewal comes up, you should have options and terms. And the last thing I'll say on this is get your payments quoted, because it might sound like you're getting a cheaper rate by going with the 3-year versus the 2-year or the 4-year, but if the payment itself is a significant jump, when you come up for renewal, that's your chance to be a free agent. Then you can look at, and I'll let Derek explain this a bit more, you can look at re-amortizing, rolling back your payments, all that kind of stuff. But just to agree to a rate without actually knowing, the payment that you're looking at is a little bit dangerous, right? Because you might pick the 5-year because it's the cheapest rate. Then you see the payment and you're like, oh my God, I can't handle this. We got to sell. And then you break that 5-year early, you're going to be stuck with a massive penalty.
You think about how many clients like a big bank has with mortgages, like they just simply don't have the people, they don't have the staff to like reach out and book a meeting and book a phone call for every single renewal that's coming up. So they just blanket send these out in the mail, through an app, through an email. Like there is no conversation. And I would say that like literally 99% of consumers that have a mortgage need to have a conversation about whether it be products or like, do you need to re-amortize, or do you need to pull some money out to do that renovation, or whatever it might be. There's so many different situations that can come up. And again, that free agent piece, like I couldn't agree more. Like that's your opportunity to change something if it makes sense to make the change. And there's typically a lot of benefit in doing that without triggering massive penalties after the fact. So yeah, I think it's just quite literally, and that's where like a broker comes into play is, most brokers have a database, but it's manageable, that like you can reach out and like you can even automate these things, and you can book a phone call and you can talk to someone that's actually working in your best interest, right? Talking about different lender options and different products. And again, at the end of the day, like for a broker, we have the consumer's best interest in mind. And if we don't, it shows. And those clients wouldn't come back to that broker the next time they're up for renewal if it wasn't processed properly.
So let's just touch on that payment shock and understanding what the payment is. That's a really good piece of advice, is to get that payment quoted. Let's just assume payment has doubled from what you currently are coming out of. That is a significant shock. Even, I mean, that may be the extreme side of things, but it's common. We are seeing that. We are seeing people have payments jump as much as double. And so what can we do about that? So you can re-amortize the mortgage. A lot of people don't like that thought, or that thought is scary. And so what we mean by that is, let's say you have 20 years left on your amortization. So 20 years left to paying off the full balance of that mortgage. You can re-amortize that mortgage back up to 30 years. And a lot of people think of that as like, that's crazy. Why would I add another 10 years of paying down my mortgage? And it's a good way to think. Obviously, you don't want to add debt for more time than you need. But the best way to look at this is what it does is it establishes a minimum payment threshold that's much lower than what you're being quoted. And knowing that, this isn't going to last forever, it can be a bridge to getting through some tough times and ultimately staying in the house and not having to sell the house. And that's super important to hone in on. And if you can get to that payment that's, let's say, maybe $500 more opposed to $1,000 more because you re-amortize, and that allows you to stay in your home and get through, say, the next 1 year, you can look at that plan again in 1 year and look at increasing the payment. You can always increase the payment back up to what you would expect to be at from a perspective of getting this mortgage paid off in 20 years. We can give you that payment amount to help you get back to that point later on. But this bridges the gap again to get through the next 12 months. So that's something that's really important to consider, is re-amortization is not a bad thing, and it can really help you. Second of all, it can really help you for qualification on future investment. So if you're considering buying a property, let's say maybe you don't, the payment shock isn't going to change your lifestyle too much. You're not really concerned about it, but you have plans to buy an investment property down the road, or a vacation home. Re-amortization again is something to really consider, because that minimum payment threshold is what's going to report on your credit bureau. So you can still have a payment that pays your mortgage off in 20 years because you increased the payment, but the re-amortization has brought the minimum payment down to a much lower number, which is what's going to be used to qualify for other properties. So always consider re-amortization at this time, because again, to Tyler's point, you are a free agent, you are avoiding penalties and all those sorts of things that are going to cost you down the road if you choose to do this down the road when you've already renewed. So just wanted to really hammer home re-amortization. And with that, maybe we can jump into some of the other options. I know Derek briefly touched on adding more debt to the mortgage. So increasing the mortgage and having, let's say, a slush fund or emergency fund for extra payments or extra life events. So Tyler, maybe take that away. Just how could you best use that? And it's also just a caution. Be careful with taking out extra money just for the sake of taking out extra money. Looking at a budget, so on and so forth. Maybe you can kind of touch on that.
Yeah, sure. I guess when I hear that, like, there's my mind goes to a few different places, right? Just because you're coming up for renewal, that's also your opportunity to maybe add money. There's no penalty to do that, right? Like, when your mortgage maturity date comes up, you can do whatever you can manage with that mortgage, right? So, maybe there is a life event coming up. Maybe your wife's going on, or your partner's going on maternity leave. There's going to be like an income change coming up, right? That could be your opportunity to either pull out some equity, right, to build in a bit of a slush fund to get you through the tougher times. Although lines of credit are, so difficult to qualify for right now, that might be a time to add one of those, right? And then that can be your sort of fallback. Maybe you can try and get you into one of those all-in-one products as well, if your current lender doesn't have those. And then there's even the more creative pieces, right? There's line of credit products that aren't available. There's line of credit products that are offered on the alternative market that'll again build in a bit of a buffer for you. And you can even go as creative, and we'll probably roll this out shortly at, from Thrive Mortgage, and probably do a podcast on it, but something called like a payment relief plan, right? Where if you look at your budget and maybe look at it over the next 12 months, 18 months, 24 months, what's your life going to cost you over that time frame? There's second mortgage products that you can essentially book. You can renew your mortgage. You can then, we can then set you up with a different product, where you're going to basically get lent all that life expenses up front, hits your bank account, and we can cap the payments of that second mortgage. The technical term is interest reserve. Essentially what it means is you're going to borrow those payments over that time frame, and then you've taken this extra chunk of money to get you through these next, again, 12, 18, 24 months, whatever that looks like. And there's no payment being made on the second, on the second piece. Of course, nothing's free. You will need to pay that out or reassess what that's going to look like in the next 2 years. But again, just to use a simple example, maybe someone's going on maternity leave. Maybe you're going back to school. Maybe you're a tradesman and you've got like 2 cycles of school coming up where you're going to go on EI, and you think this may be a benefit for you. There's always a few different things we can look at, and your mortgage maturity date is the best time to do it, because if it involves moving you from your current lender to another, you're doing it free of charge, right? Just to hammer this home, is like getting your mortgage assessed from a mortgage broker is free, right? Like there's no cost to that. And also, if you're thinking, and I've had this conversation a lot in the last couple of weeks, don't hit my credit, don't hit my credit, don't hit my credit. Us pulling your credit is not going to be the reason you don't get a mortgage, right? Like that's not going to be the reason. If there's something really wrong with your credit, like it has nothing to do with me pulling your credit. It's because there's other issues, right? And this is sort of, if you even think there might be something wrong, speaking with a mortgage professional early, we can assess that well in advance. There's a few tricks you can apply, a few strategies you can take on to maybe repair your credit, so when it does come time to renew your mortgage, that's no longer an issue. So if, again, you're getting your mortgage assessed is free of charge, and us pulling your credit or a mortgage broker pulling your credit is not going to be the reason you don't get qualified.
Going through that whole process, if your current lender is actually coming up with the best scenario for you, we will happily push you back to that institution, and we'll actually help you work with them to try to get a better offer from them. Like we'll give you some advice and some structure on how to negotiate with them. So again, like the free assessment, it's a no-brainer. It's a huge decision. This could be like a 2, 3, 4, 5-year plan. And yeah, the costs are just massive. I mean, I know a lot of this conversation is a little doom and gloom just because of what's going on. Life's very expensive. Mortgages are very expensive. There's a lot of payment shock, but there's a lot of situations where even if you're not being massively impacted by the current interest rate market, there are situations where still drawing money out could make sense, right? Like incorporated business owners that are, maybe they need to take a bunch of money out of their corporation, but it would actually be cheaper just to draw it from their equity in their primary residence, even if it is at a 6% interest rate, right? Rather than maybe a 40% tax bracket. There's things to look at like that. People will leverage their properties to invest money, and doing that in most situations, talk to your accountant, but the tax is, the interest is tax deductible, right? So there's a lot of other situations outside of just simply payment relief and consolidating debt and trying to get your payments down. There's a lot of other situations that could make sense to leverage equity. And again, just a full open review is super important at time of renewal.
Yeah, I'll just quickly jump in with one thing I just thought of, like paying off your mortgage, like in Canada these days, like it's a marathon, not a sprint, right? So I'm going to steal an analogy, right? Like imagine paying your mortgage is like running a marathon. You're going to have flat, you're going to have uphill, you're going to have downhill. Like the reason we're kind of hitting on all this, and yeah, maybe it does sound a bit doom and gloom, but it's because we've had an unprecedented run up in interest rates over the last 18 months, right? Anything in the last, 10 years, 15 years hasn't been this payment shock up or down outside of maybe the launch of the pandemic, but that was all downhill, right? So it's if you are considering rolling back or adding some money, just remember, like, we're going to be paying these mortgages off for a while, and if this gets you through the next 1, 2, 3 years, there's other things you can do to pay it off quicker. I just wanted to add that.
Yeah, great points, and just getting into a bit more doom and gloom. I'll try my best, but I think it's important to touch on, because there is positive in all of this, that there is options, and there, working with a professional, there is creativity that we can, apply to help here. And one of the big concerns that we talked about earlier in the episode, and I want to touch on this and maybe wrap up here, is just qualification issues. Qualification issues would likely, what we're seeing, why are we seeing qualification issues? Interest rate. The interest rates are so much higher that the stress test is that much higher, that it's that much harder to qualify for anything, whether it's a line of credit or any of these changes that we're suggesting might just be very difficult to qualify because of interest rates. So going back to that, payment relief program is something that can mitigate qualification concerns as well. So in the event that you just simply don't qualify for the current mortgage that you have and you can't make changes, good news is you can just auto renew. You can auto renew into one of these quotes that your current bank gave you. In those cases, we usually recommend auto renewing into a flexible product like a 1-year or a 2-year fixed mortgage, or maybe a variable. So just to give you peace of mind, you don't have to qualify to auto renew. You can just sign that letter and take it. So back to shopping and making sure and looking at all these things. If we ultimately realize that you just can't move forward with any of these changes, you can take that auto renewal and then look at the equity relief program to add supplementary funds, income, what have you, to get through this time. So there is still options. So again, don't be afraid if you don't qualify or you think you're going to have issues qualifying. Even more reason to reach out if you're thinking of that or scared of that. Job loss, we're not seeing it so much yet. In fact, the reports today are actually seeing incredible job strength right now. But in the case of a recession, which it's very likely that we're going to be dealing with, if we're not already dealing with that, we are going to see job loss. People are going to potentially lose their jobs. In those cases, you're going to get your renewal. You're still going to have an ability to renew. Again, even more reason to reach out to us right away if you're dealing with that. We can build a plan that's very similar to what I just mentioned. There's still an option to renew your home and get relief. So don't be scared there. And then the last piece I just wanted to touch on, in case any of the other guys have something else to add, I just want to touch on costs. Number one question that comes up in these cases is, what is this going to cost me? And typically, if you're taking action and doing some of these restructuring suggestions that we've made, there could be costs involved, and the costs are typically going to be legal fees. So a lawyer to register the new mortgage on title, anywhere from $1,500 to $2,000 could be the cost of that. That is always built into the mortgage as well. So that's something that wouldn't be out of pocket and could be built in. In some cases, lenders may pay for those costs, whether it's an in-house legal service like some of the banks offer. So again, something we can always mitigate and work through with you, and it would never be an out-of-pocket charge. And then appraisals. In a lot of cases, appraisals could be required. A lot of times, those are covered costs as well, but something to be prepared for. And on appraisals, and that's where I'll end off, back to a qualification piece. Now could be the best time to do anything just from an evaluation of your home. We could see values going down slightly. Not, I mean, I wouldn't, be concerned that your values are going to plummet, but values could be going down in these times. That is something that is to be aware of, and getting ahead of this again is even more important from that perspective, is to establish the value that it is at today and make these adjustments based on that value. So that's where I'll wrap up on my side, unless any of you guys have something to add from there.
I'd say just treat your renewal like when you bought your home. When you bought your home, you wanted the longest rate hold you could possibly get. With your renewal, we can save rates up to 120 days. Get a rate saved at the 120-day mark, and who knows what happens in the next 4 months. Maybe rates drop. If you're working with a mortgage broker, okay, well, maybe we've got you approved at Bank A, maybe Bank B 2 months before renewal has a much better rate. Then we jump to Bank B. So just kind of think of it like buying, but maybe in reverse.
Awesome. So just to remind everyone, there is a very detailed landing page that you can click on in the notes if you're watching this or you're listening to this. Make sure to grab the link and download the guide. It's essentially a very detailed guide, an ebook structure for you to take away all these notes that we talked about. And don't hesitate to reach out. Reach out immediately if any of this interests you or you're concerned about any of this. Like, reach out. We can set up a meeting, a very in-depth meeting, go through your options. We can do that immediately. So please don't hesitate to reach out, regardless of your situation, regardless of your questions. No questions are a stupid question around this. And make sure to download the guide and be up to speed with this and be prepared.